Buying a multifamily is difficult. You got to learn how to underwrite the deal. And that's probably one of the hardest parts. Understanding that what you're going to make when you buy the property and knowing that you're correct is probably one of the hardest things to do. Once you've got it and you bought the property, you want to value add. I'm sure a lot of your listeners do the value add, which is amazing, which is absolutely awesome. We found a property for me and my partners found a properties for, it was 850,000, 16 unit in North Carolina. Best thing we've ever done in our life.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us Michael Mannino. Michael is a licensed master builder in Michigan and Florida. With over 35 years in the construction industry, he has built, renovated, and remodeled residential houses, including multi-million-dollar homes for local celebrities. He is a founder of several multi-million-dollar companies that build and flip houses and invest in multifamily real estate. Michael, welcome to the show.
Thank you, sir. I really do appreciate it.
Yeah, it is great to have you. So you have quite a varied real estate background, and I definitely want to get into that. But before I do, I have to ask, can you name any of the famous clients that you've built houses for?
The most famous I could give you, his first name is Mannino. You might know him as the owner of 5 Hour Energy, my first billionaire that I've talked to in my life. One of the nicest people I've ever met in my life. It was just really kind of cool. I had this poor concept of people that had money growing up. I thought the richer, the more arrogant, the more mean, and more just nasty. The higher, the nastier. And then when I started meeting millionaires and billionaires, it was the total opposite. The higher they got, the nicer they were.
Yeah, and I think it's one of those things that I've read multiple times. Money doesn't change you. It just brings out who you really are. If you're a jerk, then you're just going to be a rich jerk once you have money, and vice versa, right?
Yeah.
All right.
Someone had a quote, if I can give you this one. Someone had a quote, and it said, you can be a jerk and be a millionaire. You can't be a church and be a billionaire.
I don't know if I completely agree, but I get the point. Because you need other people in order to get to that level. That's certainly true. Unless it was just passed down to you from mommy or daddy. But please tell us about how you got started on your journey and how you got to where you are today.
That is a great question. I do appreciate it. That's a multifaceted question. The best way to describe it is one step at a time. The first thing I did at 23 is bought a house. I bought that house and then I fixed up. There's a back aluminum porch area. I reframed it and then put drywall and just redid it. So I added more square footage to the house. Then I built a garage. I bought that house for $50,000, sold it for $100,000. That's really my first real estate adventure at 23 years old. And then I got the bug in that one. And I was like, oh, I can find something, fix it up, make more money on it. Let's see what happens. And then I just kept going through my career in building, flipping, multifamily. And the one part maybe I can share the best with your viewers is the personal aspect of how you can make money in your personal life. Being a builder helped out to build my own house. You can hire a builder to do your own house. Houses appreciate the most in the first 7 years. So if you buy a house, build it, have somebody build it for you, the next 7 years is going to appreciate the most. What I did, this is a hack that I would highly suggest if you have the ability to do. This is amazing. I bought that house, bought it for 50, sold it for 100. Years go by, I built my next house. I built every house after that for myself. The last two houses I bought and built. I think put $400,000 into one in Lake Orion, Michigan, and then I waited 4 years, and then I sold it, and then I sold it for $700,000. I took $300,000 of profit in my pocket and had paid zero taxes on it. Then I'm like, oh, this is nice. And I thought about all the other houses that I bought. Everybody has this conception that if you buy a house, you have to buy it for more. You have to buy another one for more money. You don't have to pay taxes on the property that you just sold. You don't have to pay taxes on the profit. That's not true. You can buy a house for $50,000 and sell it for $1 million. Oh, now you can't do that. You can buy a house for $500,000 and sell it for $750,000 if you're single and not pay any tax. All you have to do is stay in it for 2 years. right? You have to live in it 2 of the last 5 years. Now, if you're married, you can be $500,000. So it helps you to be married in this country. So I did that twice in the last 7 years, and I made $600,000 profit tax free.
Yeah, and I think that's an important point. People sometimes just forget about the fundamentals. We try to get way too fancy on all these different ways to make money, but there's some very basic stuff out there that people lose sight of. And I understand that a lot of folks are getting discouraged nowadays because it's not as easy to buy a house as it was for you or for me. I bought a house before I was 30 also. Now, if I ask someone who's under 30 if they expect to buy a house, they'd probably laugh at me just because of the interest rates, the affordability. Some of that stuff isn't there, but I think they still need to remember some of those basic things like the tax advantages associated. Like you said, living in it for 2 years, that was your primary residence. So anything you make off that, like you said, tax free up to a certain point. And then, like you said, if they're married, even better, right? A 500,000. Remembering those basic lessons as early on as possible, you could take advantage of those and then compound it over time into different things. And obviously, I think a lot of people still accept that owning a home is a way to build wealth. It's not,
Grant Cardone says, don't own a house, rent it. And I was like, I disagree with him. I'd love to show him the numbers and see how that works.
yeah, and I don't know. Yeah, we could get into this conversation of which makes sense, and it probably depends on locale and everything else. If you're living in New York City or Los Angeles, does it make sense to try to buy a house for minimum $1 million if you're on a $60,000 a year income? Probably not. At that point, maybe it's better to rent and invest the money that would have put for that down payment. But those are individual circumstances, so it's so hard to get into that. I know that I have benefited from owning a house, but I'll readily admit the first house I owned, I didn't make any money off of it because
Really?
I bought it in about 2005. So timing is always an issue too, right? Just like it's an issue for people now. I bought my house in 2005 and then wound up having to sell it in 2008. And while I didn't lose money on it, I was lucky to break even.
Yes.
And I'll walk away with that one and consider it a win compared to so many people who lost so much during that time, which we spoke about before the podcast even started. But sorry, just to get off track, but I just really wanted to emphasize the going with the basics again when it comes to simple things like the general tax laws and home ownership. But sorry, go ahead.
You really pushed on a really big point. I don't think people really understand just yet. I was very blessed to move on to I got a canal to the Gulf of Mexico in Florida now. And I learned something since I moved here about a year and a half ago from Michigan, that the water rises and falls 3 feet twice a day. Sometimes it's harder for it to get out on a boat, and sometimes it's easy to get on a boat. And then my neighbor said, how are you doing with the Gulf? And I'm like, I'm learning when you go is more important than where you go. And he, yeah, that makes sense, because when tides are high, you can go anywhere in the Gulf. But when tides are low, you're going to hit rocks, you're going to hit coral, you're going to shear off your drive. It's harder to get to where you need to be. Now, I really recently, this is probably the greatest gift I can give. Recently, I figured out when you buy a property might be more important than where you buy it, because you were just alluding to, you got out and got happy breaking even with the house. The people that bought it in 05 and sold in 9 and 10, they had to lose money. They just had to. Right now, is in our state of affairs and our economy as it is now, the affordability of buying a house that you alluded to is very difficult for new buyers. But it was the same thing in 7 and 8, 6, 7, and 8. Remember, it was just hard to get a house because you had to, put so much money down. The interest rates were 6, 7%. It was difficult because it cost too much. It's the same thing right now. I have a feeling we're going to start tipping and going the other way, and the values will drop or stay even while income goes up, which is the big problem right now. Our income isn't matching the affordability of the houses. So that's going to be leveling out the next year and a half, 2 years. And that's when you should buy a house or buy a piece of property or buy a multifamily. I really feel that the time to buy is coming soon.
Yeah, it's tricky though. I talked to some realtors and stuff like that, and they bring up some things that I don't really think about because I don't think about it at the single family level all the time because I just don't plan on moving. But I
There you
was
go.
like, yeah, and they're like, it may not get better, and the reason is because of so much pent up demand. No one is buying right now, so they're saying if rates drop by even a point or a point and a half, they think that there's going to be a ton of people that flood into the market, which is great, right? People are going to be able to get homes, sellers are going to be able to sell homes. But then what happens? Then supply demand imbalance and all that demand is going to drive up prices even more. So I don't know which way it's going to go, but it'll certainly be interesting to see. Meanwhile, I'll be sitting back comfortably with my 2.5% interest rate staying out of the fray. But
Oh, you're a lucky man. Keep that.
yeah,
Keep that as long as you can. You knock it out of the park with the interest rates. Beautiful.
I,
It. I feel I can't. I can. You can prove either way nowadays with all the information out there. You really can. You can prove either way. I think when the government raised interest rates, the only reason they did it was to stag the economy. I've
mhm.
noticed one thing over the 50 years, 57 years I've been here. If the government's trying to do something, screw something up, they'll do it. They'll do it. They'll knock it out of the park with that. So I'm hopeful that they keep talking about a soft landing. I think if things start to tip and it goes down and they're concentrating on the soft landing, I think that'll help out the economy and the individuals, the people that are struggling the most.
Oh yeah, but there'll be a ton of benefits if rates start to go down. I question how fast they'll go down. A lot of people are looking at this with rose-colored glasses. I'm like, it's not going to go down as fast as it went up. We were spoiled, literally
Yes.
spoiled for way
Yes.
too long with
Yes.
0% interest rates, which I think personally was just as irresponsible of the Fed to even allow that to happen. But no one
I
wants to
agree.
be that guy and say, hey, I know everyone's having a party, but we need to shut it down. So he was hesitant to do anything about it. All right, why don't you take us a little further ahead? So, you started with your own residence, then started building other houses. What did that turn into?
That turned into with problems comes adversity. What that turned into was just learning about real estate. I wish I would have learned more younger. If you guys are 20 to 30, just start listening to podcasts, reading books, and just doing as much as you possibly can about real estate. Real estate is the most powerful tool in the world. I think it was Dwight D. Eisenhower said compounding interest is the most powerful force in the universe. Real estate compounds in multiple different ways. Both me and you know about this. I started off with the building and then got into the flipping and I had each company separate. So we had a building company, we had a flipping company, and then we had a finding the deals company, and then just making the companies run themselves. Having a company that you don't need to be there to run it is an actual business. Everything else is a job. So concentrate on getting your company to the point where you're not needed in the company. So you're just working on the company, not in the company. And then once you do that, you can start another adventure. So just mine was just basic construction, flipping, building. Now I'm getting into multifamily. The last few years, I got into multifamily. That's where everything is. If I would have known how awesome multifamily is now, I would have done that 30 years ago. Buying a multifamily is difficult. You got to learn. You got to learn how to underrate the deal, and that's probably one of the hardest parts. Understanding that what you're going to make when you buy the property and knowing that you're correct on it is probably one of the hardest things to do. Once you've got it and you bought the property, you want to value add. I'm sure a lot of your listeners do the value add, which is amazing, which is absolutely awesome. We found a property for me and my partners found a properties for I think it was 850,000, 16 unit in North Carolina. Best thing we've ever done in our life. The cash flow at first it didn't look that great because he was charging 650 per door. The cash flow is like, oh, it doesn't look that right. And this is a year and a half ago. He didn't understand that the rents around the area could go up to $1,000. So we bought this property for 850,000, probably put 150 into it and raised the rents from 650 to $1,000 a month. So we're making $16,000 income. Your NOI, you're about 750. It's working out absolutely amazing. Now we're trying to refinance the deal. And this is the best. I love real estate. I love real estate. There's there's 3 or 4 different ways to make money. Cash flow. You can make money per month. And then there's appreciation. The property's going to go up in value. And then there's depreciation, which I highly suggest that anybody who's done this, you have to tell everybody about it. This is where the rich don't pay taxes. The depreciation, we did a cost segregation on the property. We did cost segregation on 2 properties bought last year. And I paid, as a entrepreneur, you got to pay your taxes, right? So the end of the year came around, I put a large sum of money down because my tax accountant said, you got to put this much away. And then we did the 2 cost segregations and then the taxes from the other properties each year, the depreciation of the properties. And I ended up getting back 90% of what I gave them last year. So I was kicking my heels to tell everybody about real estate for the rest of my life. This is just absolutely amazing. Making money and paying little taxes to none is probably the biggest key I could give away on the multifamily. And then we refinancing the property right now. A year and a half later, people were moving out. We fixed up the units. So we probably got about 10 fixed up. We got 6 left to do. Some people just aren't leaving. And we raised the rent from $650 to $925, and they just stayed.
Oh, wow.
Yeah. Now the actual value of the property was around 1. Now we got it up to 1.7, and we're pulling out 300. We had to put some money down on the property, so we're pulling out $375,000, and it's debt. And we're going to take the income from that debt. We're going to split it up between the partners, and we're not going to pay a dime on taxes on that because it's not earned income. And now the value of the property is 1.7. So this multifamily gig is amazing.
So that deal right there, was that a joint venture or was that something that you raised money from investors?
Yeah, that was a joint venture. Have a little bit of money. Has some friends that have money. Like joint ventures, there's just a lot less paperwork, but the key to that is having good partners.
Absolutely.
I'm sure anybody that's had bad partners knows don't get bad partners.
Yeah, and I've one of my best performing deals is a joint venture in Ocala, 24 units, relatively small. I know that's not small to most people, but relatively small. And I love it. It's performing better than I expected in a secondary market, but it's in that path of progress and rents have just kept going up. We've maintained occupancy. So things are just working out, right? But like you said, you need to have good partners on that. And you also need to have a lot of capital up front, right? And so that's one of the challenges versus the syndication model. But then on the syndication model, you have to build in the returns to the investors. So it has to be an even better deal in order to provide that.
Agreed, 1,000%. Yeah, the syndication aspect of it just has another complexity to it, but you need it for the bigger deals, right?
Yeah.
Unless you're a billionaire and you can put $5 million in each property until the day you die, which I don't think everybody. There's a lot less of those guys out there than most.
Yeah,
but
so
joint ventures I feel are the best. So you could correct me if I'm wrong. Syndications are obviously second best. I love those too. And here's one thing that I loved about syndication is, can people outside of multifamily get the returns from any other vehicle than multifamily?
Not that I know of. And I think I would add to that what you were talking about with the cost segregation analysis that you did on your North Carolina property. Just if people aren't familiar, you're basically fast forwarding, supercharging the depreciation on the property, right? And taking a larger chunk up front rather than doing it over 27 years of the usable life of the property. And they do that by breaking it down into the segments and literally figuring out, okay, how much is the carpet depreciated, this, that. Without getting into the nuts and bolts of it, that's the idea. And so that allows you to take a whole lot of depreciation up front. And that's not only applicable to the owners, because on syndication deals, I think it's important that passive investors understand this, you get that depreciation too. So say you've gotten distributions that year of $2,000 or whatever it was. It was kicking off some profit. You got your distribution for $2,000. That's part of your taxable income.
Right.
But if you get that K1 from your sponsor and he says, hey, passive investor, we got a big chunk of depreciation. Here's yours. And it's $2,000 of a loss, well, then guess what? That just cleared out that 2000 in taxable income that you had. So you essentially made $2,000 tax free. That's just an example, but it's a very realistic example.
That's a very good point. If you think about it, let's just put it to 20,000 and a big deal, and you have a little bit of money into the property, and then you're going to make 20,000 on this deal. And then you get a 20,000 loss. It's a 10 million, $20 million property. And you get a $20,000 loss, you make $20,000, and you happen to be doing really good at whatever you're doing in your life. You might be an accountant, have a company, or whatever it is. That 20,000, if you were to put it into your earned income, and you're at a 40% tax rate, which is possible for the really good guys, right? 30 to 40%. Let's just say 40% is 80 grand that you're not paying taxes on. That's a big difference. And if you, like me, find a decent property and they're just happened a brand new build, what's the depreciation to be on a brand new build? We're thinking about building a property in North Carolina right now. And if it's $30 million, it could be $10 million of depreciation in the first 5 years. I'm assuming anybody in that deal probably won't be paying taxes for the next 5 years.
Yep. No, that's an important point that, in addition to whatever income you got from that investment, if it lowers your tax base, then that could save you money, overall. Now, it's important to point out, and I don't think you're a CPA. I'm not a CPA either. None of this is tax advice. And, for someone who isn't a real estate professional, you can't use it to write down your personal income from your job. Right.
Correct.
So,
exactly. Good point. I'm not a tax advisor. We don't consult with your tax advisor on anything that we say.
Yeah. It's still an amazing benefit regardless, but talk to your tax advisor, like you said. All right. I'm interested to know what made you make the transition from the flipping, and I suppose it's not necessarily a transition if you're still doing it, but what attracted you to multifamily? What was your introduction to multifamily? What did that first deal look like? How did you get involved with it?
That's a great question. Just like I bought my first house for $50,000. As time goes on, you learn a lot. I've heard all the benefits. Probably a podcast like yours saying, "Oh, multifamily is the best," and some idiot like me talking, "Oh, I'm not paying taxes." They like perks your interest when you're paying a lot of money in taxes a year. The problem with making money is you got to pay a lot of money in taxes. So that was my reason. I'm like, I want to see Robert Kiyosaki. I'm probably going to butcher the name. Says, I don't pay taxes. I don't pay taxes. And I was like, I got to find out about this. And then my first real introduction, I had a couple of properties. I had a partner, my son, my best partner in the world, found a 4-unit in Pontiac, Michigan, which is not the greatest area. So obviously it's $40,000, not a great area. We bought it. And we're rehabbers. We started fixing it up. And then we started putting people in. There's a couple of units weren't even livable. So we fixed up the units, put the people in, probably put $60,000 into it. Then a couple of years later, we sold it for $200,000. Now that's going to get my interest. That's going to guide me into, and that was out cost segregation. That was not paying tax. That was just literally flipping houses. We got into flipping a 4-unit. Oh, this is cool. I like this. And then I bought an 8-unit, and then our partners bought a 6-unit, and we bought a 17-unit and an 11-unit. And they're all in desperate need of repair. I know how to fix stuff up. So it works out great for everybody. One of the partners brought the capital. My son brought finding the deal, and I brought the rehab expertise to the deals. And we fixed them all up. We're in the process of fixing a 17-unit up in Redford, Michigan. That's the hardest one. So it doesn't seem like the hardest problems are the most profitable. But we found this deal and we couldn't believe it. Really super small units. There's 17 up in Redford, Michigan. The guy wanted to just take it from me. And we offered $225,000. It's like $11,000, some ridiculous number, but they need a lot of work. We're putting into the units in most of them more than we bought them for.
Right.
Does that make sense?
Yes.
Then we're going to have an asset worth over $1 million. So it's cool. How I got into it, I love fixing things. Just love it. If you give me a big project to fix, people call me up and say, "Hey, we have a 200-unit in Texas. What do you need?" "I need a rehab in a year and a half." "All right, let's do it." Look at me like, "Is this possible?" I'm like, And because of my expertise, I was very blessed to get involved with the Life Remodel, where we built the house in 6 days. And so that experience there taught me just how to finite put every piece together to do anything on any property at any time.
Yeah, and that's obviously a great skill to have in this business, and one that's in high demand. So along with that, for someone with such a long and accomplished construction background, I would have thought that you'd be doing more development projects, and it sounds like you might be going there. I guess I'm just curious why that wasn't a natural segue for you.
Great question. I love your questions, young man. Your questions are the best. So partners, for the last 7-8 years, my son's been my partner, and he's been knocking out of the park and finding good deals. And he's not interested in building. So he's starting some other adventures. He's doing real estate coaching. So he's showing people how to flip houses, showing how to make a flip house company like we did. He did a great job. He's able to teach it now. So it gives me the freedom to do what I've always wanted, build a multifamily. So all we're doing right now is looking for partners and looking for pieces of property that will accommodate in the area that's going to accommodate a new build. And I love North Carolina, like South Carolina, Florida, and anywhere that's going to make sense. The higher numbers, like you like 100 to 200, everybody's telling me 250. 250 is the number. And I get to live my dream. I'm gonna end up moving to wherever I build for the next year and a half and just do something amazing.
That's awesome. I look forward to seeing where that goes. But right now, we do need to head into the turbo round. So you ready for that?
Born ready.
All right. So I'm going to ask you 3 questions that I ask every guest that I have on the show. And I just ask you for a relatively quick, honest answer. First one, what is one red flag that every investor should look out for?
Probably the most important, if you want to go my most important, partners. The right partner will make or break a deal. And I've been blessed to have the greatest partners on the planet, period. And what most people miss on that is your husband or your wife is your partner. And they have the number one indicator whether you're going to fail or succeed in this world. Choose wisely. I've seen so many multimillionaires get a divorce and lose half. That's a poor partner decision. Does that make sense?
Yeah, divorce is expensive.
From what I've heard from the people that have done it, it's so expensive because it's worth it. If you have a bad partner, paying half to get out is really an option for some people. I've been blessed to have a girl that's 30 years together and married for 32. And thank you. She's the perfect partner. That's really the key. So partner in life and partner in business. That's the number one. That's just literally by far and away that dwarfs any other red flag.
Yeah, no, totally agree. And so vetting those partners is vital, knowing who you're getting into those partnerships with. All right, second question. What is a myth about this business that you would like to set straight?
That's a good one. That's another good one. The myth is, I can't do it. I'm sure that voice rang in your head and it rang in my head. It didn't really ring in my head. I have a little different outlook on life than most people. But a lot of people are like, I can't do it. I can't do it. And I was a professional brick breaker and a Fifth Degree black belt. And I taught many people how to do things that they didn't think they could do. Break bricks, break boards, do a hurricane kick. So what I would tell people, what's the hardest part of a martial arts instructor is to pull can't out of my student's forehead. If I can just pull can't out of your head, I can get you to do anything. And that can't is probably the biggest thing, the misconception. I can't do real estate.
Yeah, that's a really great point. And like you said, with your unique background in martial arts, you've surpassed the can'ts already, and now you're on a mission to get other people to do the same. And the sooner people can get that can't out of their head, the sooner they can take action. Because the can't, I think, prevents them from even taking action in the first place. And obviously, you can't go anywhere until you take that first step.
I say this to all my students. Now I teach martial artists how to teach martial artists. And whenever I have a seminar or a meeting, I say, tell me what you can do and tell me what you can't do. And I say, I can't do this. Okay, cool. What can you do? Oh, I can do this. And the first time I say, what can I do? You're right. And I can do this. You're right. Whether you say you can or cannot, you're right either way.
Yep, absolutely. All right. And the final question, Michael, what does success look like to you?
See, I'm at the when, just like the boat ride, when. So what would success look like to me at 25 is where I'm sitting now. What success looks like for me now is just to be successful at everything you do. Now, let me define that a little bit. You only do 5 things, right? You're a real estate investor, right? Are you married?
Yes,
You a dad?
I am. 2 girls.
Hey, congratulations. Those are awesome. What about hobbies? What do you do?
I like to travel, international travel.
Travel. What else? What else do you like to do?
Work out.
Work out. Good. Physical. Yeah. Perfect. Do you do much more out of those 5 things that you do? Do you do much more in your time? Just for those 5 things: the real estate, the wife, the husband, travel, and the workout. What % of that is your week, your month, or year?
Most of it.
There you go. So you only really do 5 things. That's what I'm trying to say. Being successful is being a great husband, being a great father, and then being a great real estate investor and helping people invest in real estate. Being a great, for me, as a martial arts, is working out. So you only do 5 things. Successful is being really good at those 5 things. That's all you have to do. You know what I mean? That's success to me. And being happy. Being really good at 5 things and being happy at what you do. That's really, truly a success.
Yeah, I think that makes a lot of sense. I think that's the first time we've heard that on the show, but it makes sense to me in the sense that sometimes you need to focus down. We can easily get distracted by so many things in life that sometimes you need to just stop, refocus on those things that matter, and that's where you need to put your energy.
Yeah. Because you do anyways, you just don't realize it.
Yeah.
It's like you only do 5 things, 5 to 8 things top. Most people, super high performers, 8 things. Me, 4. It's really just being good at whatever you do in the day, and then how many days you do it. It's really that simple.
All right, Michael. Hey, this has been awesome. I really enjoyed our conversation. Please tell our listeners how they can get a hold of you and if there's anything else that you'd like to share with them.
Just do it. Just do it. Whether you say you can or cannot, you're right either way. Just do it. Get into real estate. It will blow your mind. Multifamily has been just the most knockdown, drag out, greatest thing I've done. And I've done a lot of cool things in this world. If you get in touch with me, right now I'm opening a new company, Arc Investment Ventures. I haven't got the website or the email set up, so we're going to have to give you my personal. It's Mannino, MANNINOMT @gmail.com. And as soon as I get the other website up, as soon as we get the website up and the emails out, I'll let you know.
All right, awesome. We'll definitely have all that in the show notes. Again, Michael, thanks for coming on the show, and I appreciate you and look forward to continuing to see you do big things on your journey to multifamily millions.
All right, man. Thank you very much for everything. And if I can help in any way, please let me know. And thanks for the podcast. I really do appreciate it. You're really adding value to all these people's lives, and I hope you do appreciate it.
Thank you. You're doing the same.
Thanks, brother.
Bye.